Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and something that we have been trying now to do once every month, which is try and talk about the most pressing issues by people who have a bunch of clients under them and advise those guys on all of those issues. So we thought it's best to get in 2 or 3 of those eminent experts on the platform together and talk about the 3 or 4 most pressing conversations within the mutual fund industry right now. Joining us on the show today to talk about, well, 4 or 5 of those issues are Vishal, Dhawan, founder and CEO of Plan Wealth Advisors, Anant, Ladha, founder of Arbitrage for Kal, and Suresh, Sadagopan, founder of Ladha 7 Financial Advisories. Gentlemen, all of you, thank you so much for taking the time out and being with us. Thank you. Before we get to the 5 topics at hand, just very quickly, any of you wants to come in? This announcement that came in post Friday evening, wherein Reliance Mutual Fund said that they are they'll be marking down some of the exposures that they had to 2 of those companies. It's created quite a bit of a not a furore really in that sense, but a bit of activity on my social media timeline. For example, a lot of people asking, are my funds safe? Not just the debt funds, are my equity funds safe, etc. Is it a big issue? Is it a less understood issue? Or is it a very small issue? Any of you?
I personally feel when there is fear in market, it is best time to invest. Now finally people are fearing debt funds. And that is why I feel now it is best time to invest in credit or corporate risk debt funds.
No, but specifically for the Reliance Mutual Funds, that's my question really. For these 2 funds, what's the issue? Is that a big issue?
So essentially the way we look at it is there was clearly a belief that, when you buy a hybrid fund, which is where a lot of these issues have come up, you focus on the equity portfolio, you don't focus on the debt side. And suddenly you start to see the part of the portfolio which you perceived to be safe becoming the problem. And I think that's where fear comes in, because all our minds play with us in such a way that we say, there's a safe part and there's an unsafe part. And the moment you start to see the safe part running into trouble, you start to worry about what about the unsafe part. So essentially the way we look at it is, if you look at the numbers, the exposure is not very large. I think the message is very clear that I think even for debt parts of the portfolio, what one will have to look at very carefully is how do you actually keep the exposure to a limited level by the security that you hold. I think somehow with mid-cap and small-cap kind of stocks, fund managers over a period of time have figured out that you need to diversify your book so that you don't take extra risk on the portfolio. I think even with debt securities, considering the illiquidity on those securities, it's now time for fund managers to step back and say, should I be having a very diversified book? Because I don't know whether I'll have a AAA security that will suddenly go bad. Okay. And therefore, I don't want to expose the entire portfolio to that risk.
Okay. The last word on this. So if I or any of the viewers watching this have exposure to the ADAG group mutual funds, which might have exposure to Reliance Commercial Finance and the Reliance Home Finance, should I be worried or is this manageable risk?
I think he had a word on that. I mean, the exposures are not currently extremely high. And at this point in time, there is not much you can do. I mean, the exposure is there, you know that it is there, the world knows that it is there. So there is nothing much you can do about it. But having said that, as far as hybrid funds are concerned, I think the debt portion of the portfolio should have been ideally invested in safer debt components, not necessarily in a A-rated paper or thereabouts. So if I were to look at it that way, to start with, that is not the right thing to do, first and foremost. And the second thing, we are having a problem not just in mutual funds as far as debt is concerned, it's a problem in the debt market. Okay, and it is also impacting mutual funds. So what do you do? What does the fund manager do if you have a AAA rated security suddenly going all the way to D? So that's a systemic problem.
Okay, fair call. So difficult to do anything at this point of time, but I guess this is the best way to do it, right? With your own portfolio, depending on the kind of exposure that you have to any of these funds, do consult your financial advisor and try and get a sense of that. Let's move on to the 4 or 5 key things that we wanted to discuss on the show, aside of this big question, of course, for the day. And that is, first one, an ad that is coming in largely via the Aditya Birla Services Group right now, which is that if you invest in this mutual fund, you get term insurance along with. Now, all through the past, and then let me start off this conversation with you, all through the past, we've learned that keep insurance and investment products separate. The normal, therefore, response would be, why club these 2? But this is not coming at an expense, the insurance bit, right?
Yeah.
So should one do this? Should one not do this? Is it even a point worth giving too much of thought over because it's not coming at a cost?
So I personally feel it's a blessing for mutual fund investors and industry as a whole. traditional investment plans were always sold by saying by focusing on the insurance part, and now when mutual fund SIPs will give you free insurance, I'm sure everyone will be very excited to do it. And the best part about this free insurance is you have to keep your funds intact for long term. That is any which ways we want for a mutual fund investor or an equity investor. So these are it is aligning two things. One is long term part and giving insurance absolutely free. So I think people will enjoy it. Investors will have happy run through it, because if mutual fund investors are keeping money for long term, they're bound to make money. If they make money, they'll feel happy. Whether they keep it for insurance part or for equity part, they're bound to make money. So I think it's an added advantage and a thumbs up step by mutual funds.
Okay, either of you, the views differ or supplement?
Yeah, so I think we've seen this free insurance bit happen with, for example, the card industry, right, in the past, and we've always seen that somehow the side item becomes more important than the core. And to us, insurance, when you're trying to do investments largely, is actually the satellite item. The core reason why you're investing is because you want your money to grow to a certain level so that it can help you meet certain goals and objectives. Now, the moment you combine this together, our view always is that it's going to hold you back when you got to take decisions on the quality of the performance of the fund. So let's say, for example, you go 2 years out and you find that your fund manager is not doing his job in the way that you hoped he would against his peer group. You want to come out, but what's going to hold you back is the insurance. Or on a normal fund, you have an exit load which is just 1 year. On some of these, you're going to have exit loads which are 2 years, 3 years, holding you back. I think most importantly, you can't get access to all the schemes of a fund manager. And ultimately, the reason why the fund industry works so well is because it's open architecture. You can go where you want. You can pick the manager of your choice. If you don't like active funds, you go to passive. You do all of those things. And ultimately, you kind of focus on your investment choices. And I think that's what's missing the moment you add on term insurance, because all of a sudden this becomes like a chain for you and you're holding back saying, no, I can't come out because remember I have a term insurance.
That's a pertinent point as well. So two sides to the coin. Suresh, you want to add something, because this is turning out to be an interesting mix of arguments.
Yeah. So there is one more point I want to add to what Vishal had said. See, when you want to take term insurance, it's not that you want to take 8 or 10 lakhs what is coming free. Okay, a normal person for whom we offer term insurance, maybe we'll give 1 crore, 2 crores, 3 crores, some kind of a credible number. So what is happening here is that there is an insurance which is coming at maybe free at 8 lakhs or 10 lakhs. And like he said, we will have to keep that going just because it is free and just because I have already opted for it. So there is something holding me back as an investor to not get out of that fund, even if it is not performing relatively well as compared to some other candidates. So I'm just going to just latch on to that fund, and that probably may not be a good thing for the investor.
Okay, so and you could argue either direction, to be honest, on this, but I think both views or both sets of views work out well. There's some people who believe that it is great, as Anant does, but other gentlemen have pertinent points too. Let's see if the views differ on the other question. The second conversation that we wanted to have on the show was the NFOs that are open right now, because there's a lot of advertisement that happens around NFOs. We get a lot of queries whether this is a great NFO to invest in or no, etc. Vishal, if I can start off with you. 2 or 3 NFOs that are open right now, I believe Mid Asset Focused Fund, this Principal Small Cap Fund, Multicap Fund, and maybe 1 or 2 more. But if you've analyzed any of these NFOs and if you believe it's worth the investor's time and money to go out and invest in these.
So we tend to say that you need to look at an NFO only if it comes in with something unique that exists, which doesn't exist at all.
In any of these?
In any of these. And unfortunately, all of these are kind of getting added on funds to the categories that they're already part of. So you'll have a lot of these names having great track records on other sides. Mire, for example, has done extremely well on the equity side with their other funds. But I think there are other focus funds that investors can look at if they want to. There are track records. You can track this fund. If it does well over a period of time, come in. It's perfectly okay to buy, after a period of time. You've seen fund managers perform and kind of take advantage of it. The same thing with Principal, for example. It's the same story that, they have some good schemes, but the question is this the first small cap fund in the market? And the answer is no. So therefore our view is that, you need something unique to come in to actually go out and say, yes, I'm going to put my money in before I have a track record to go back to.
Okay. Either of you has a view which is differing?
So I want to add to his view. I feel investing in these NFO would be like hoping rather than investing. We are hoping that these funds will do good in future. We don't have a track record. So I will prefer an existing fund. But if I have to put my bet on one out of these 4 funds, I'll put it on ITI Multicap Fund. That's because of the track record of the fund managers. George, as we all know, has managed ICICI Multicap Fund and even long-term equity fund quite well of lately. And so does the other fund manager from who is ex-Tata. He has done quite well with Tata Tech Saving Fund, Pure Value Fund. So if I have to choose, I will choose ITI. Otherwise, it's good if new investor can avoid these funds.
Okay, fair point. The third point, and I'll talk about the KYC norms in a bit, something that has become a bit of a habit, and which is why I thought it was important. And Suresh, I want to start this conversation with you, because as a result of the direct investing mechanism, what's happened is when we see a lot of people, and we tell a lot of times on our shows, then don't go out and sort the funds that have performed the best by the ranking and then invest in that fund, because that may not necessarily be the right way. It may turn out to be good, but it may not necessarily. And then we thought, why not look at, since we're in the month of April, look at FY19 and look at the multi-cap category, because a lot of people say that's one of the better categories to invest in because it gives you the advantages of all market caps. And we thought, let's look at all the multi-cap funds that have done the best, 2 or 3 of the best performing multi-cap funds, and whether you guys believe that any of these funds might still be good enough to invest in if somebody is looking at multi-cap funds. I repeat, past history is not an example of what the fund could do in the future, but having looked at these funds, if you have a view on any of these, Suresh.
See, first and foremost, when we actually analyze the universe of subcategories like multi-cap, we don't look at only the performance alone. So we look at the short-term, long-term performance for sure. We also look at risk parameters. We look at certain other parameters like return on capital employed, return on assets, and things like that. Apart from what is the expense ratio, who is the fund manager, how long he has been. So we assign marks for all these things. And then we have a set of quartile 1 fund, quartile 2 fund, quartile 3 fund. So we sort it like that. So it's not only performance. Performance is, of course, definitely one of the factors, but it is not the only factor. So, I mean, we really cannot go by, okay, this fund has given 17.25 and this has given 16.81. 17.25 is better than 16.81.
Sure.
We really cannot take that view.
Okay.
So, to that extent, past performance, like you rightly pointed out, is not an indicator of how it will perform in future. But long-term performance of some of these funds, and especially if we apply all the parameters and criteria, then I think you will come up with credible choices.
Okay, so let's assume that you guys do not want to place your bets on funds which have, I mean, I don't know if any of you's views differ from what Suresh said. If so, then that, or else we'll move on to multi-cap funds that might be worth their weight in gold. Either of you guys have a view which is different from Suresh's?
So I think it may just be a coincidence that there might be a fund which has done extremely well in the last 1 year, and which also has a great track record. And what can therefore end up happening is you might pick it by chance. But otherwise, the good news about 2019 FI has been that there have been some schemes which have fantastic, great long-term track records, which are also appearing on the top. And at the same time, there are schemes which have very good track records, which unfortunately are actually somewhere towards the bottom as well. So you could actually make the wrong choices if you just went and picked up the best guys and let go of the worst, or vice versa. You could say, I'll never pick up the best guy for the last 1 year because he is going to underperform. And you could actually find this fund has a great long-term track record as well. Yeah, so it is tricky.
I think Jack Bogle, of course, expanded the universe, but I think in one of the podcasts I heard him saying that if a fund has done really well for 20 years, then you shun that fund, or the fund which has not done well for 20 years, buy that fund because it'll do remarkably well for the next 20. I'm guessing the answers would remain the same. So Anant, let me ask you, what is the top multi-cap fund to invest into right now?
So I would like to start my discussion with a point that best part about best performer funds is they're bound to change every year. So we need a consistent performer rather than a best performer. So when we talk about consistency, I find 2 funds very good. First is ICICI Multicap Fund. That's because it's fairly on a defensive side. They have good amount of diversification and exposure, and of lately they are having good exposure in PSUs and sectors which are not performing off lately. So that is one fund. And second fund which I have good, I think should be good, is SBI Multicap Fund. And that's because more than a fund manager's fund, it's an analyst fund. They have 8 separate analysts looking after each sector who will be tracked for their sector, and they have to outperform their sector. So this is one thing which they are doing, and best part of SBI Multicap Fund is they have removed the sector risk. We have two kinds of risk in every fund, sector risk and selection risk. They have completely copied benchmark sector. So they have zero exposure to sector risk, and they're only taking funds call. So these two are funds which I would recommend on the multi-cap side because they are defensive. They are such funds which we can map to our goals and consistently see them performing well over long term.
Okay, Vishal, any thoughts? Anything that you could tell our viewers?
Yeah, so essentially we think HDFC Equity Fund, which actually coincidentally does very well on FY19 rankings, is an extremely good choice. It's done very well over periods of time. So very clearly there have been pockets of underperformance along the way, and some of those pockets have been fairly long. And sometimes, patience of investors gets tested along the way. But essentially the reason why it seems to work very well is one is very clearly the willingness for the fund manager to make shifts across market cap with great conviction and hold on to that conviction. The second is the willingness to go concentrated, and this is very important because HDFC Equity is a very large fund. It's over 20,000 crores. And there's this general belief that, it's very hard to outperform if you have a large fund. But essentially, if you're holding large businesses and concentrated, there is an ability to generate alpha, provided you stick with your conviction. And the third is, of course, the fact that the fund managers remain there for as long as he has. I think a lot of people have grown up on that fund, literally in the fund industry. So we'd say that, it's a good fund for investors to look at. And that's why I said that sometimes you'll find a fund emerging on top, which also has a great long-term track record.
Suresh, any thoughts? Any fund that you are comfortable?
So there are a couple of funds which Anant had mentioned. Those are good funds in my view also. Apart from that, you have Kotak Standard Multicap, which has been consistently doing well for a reasonable period of time now. And in our ranking, in our composite ranking also, it is coming well in the first quartile. So that is another fund which I would recommend. Another fund which we are currently recommending, which is going into large cap, is Mirai India Equity Fund.
Sorry?
Mirai India Equity Fund, that's going into the large cap. It was a multi-cap fund once upon a time. Now they are rebadging that as a large cap fund. So those are the 2-3 funds.
Okay, great. Somebody messaged to me, and that's the fifth point before we get to KYC. That's the fourth point, rather, in the discussion before we get to the KYC discussion. A lot of people might want to know that, is arbitrage funds. Now, the conversation came about because there was an innocuous message which came in saying that it might be a great time to invest in arbitrage funds because the post-tax returns for the next 1.5 months, 2 months might be really interesting to invest into. And therefore, I thought to maybe bring up this topic to you guys and try and figure out if indeed somebody should look at these, what kind of people should look at these, what are the time horizons, if any, and if there are better options for a non-equity investor right now than arbitrage funds as well. Any of you want to start off?
So the arbitrage fund usually give return to the tune of 50 bips to 60 bips a month. Presently, what we are seeing is they might give returns up to 70 bips, which will turn out to be around 8.5% for an year. Post-tax around 7.5-8%, but I think this will not last for long. Maybe 1 month or maybe 1.5 months at max. That too at a risk. And this was mainly because of the rollovers which have happened in Feb and March. There were a lot of rollovers happening because of change in stance in equity market. 19th Feb was the clear-cut day where we had a clear, outbreak happening in the equity market due to pre-election rally. So this is the reason of that we might expect around 0.70 bips return in arbitrage fund, but I'm not sure that we should bet or not. I'm still not very confident in coming next 2-3 months.
Okay.
So essentially our view is that arbitrage funds are ideally designed for at least a 3 to 6 month investment horizon. And there will be periods along the way, like we've seen over the last 30 days, where the returns are disproportionately larger than what they've been traditionally. And I think it kind of, like always, the past tends to make us more confident about the future. Unfortunately, our view is that some of that view can change very quickly. And the challenge for arbitrage funds has always been that when there aren't arbitrage opportunities available, they start to behave like liquid products. And the moment they start to behave like liquid products, the expense ratio becomes the challenge, because there are obviously higher expenses compared to a liquid fund and an ultra short-term fund. So our view is, if you're just taking a 30-day, 45-day bet, then first of all, that category is not the right place to be in. You might be right, but that's just speculative in our view. And the second is that very clearly, if you want to get advantage of the fact that there is some tax arbitrage available, then stay invested there for 3 to 6 months. I think you could see an outperformance happen over a liquid ultra short-term fund, especially for people in the highest tax bracket. But be aware of the fact that it's not going to be linear, it's not going to be straight line. There are going to be months where one does better than the other, and I think you just ride out that entire period.
So, sorry, are you saying that in an arbitrage fund, over a 6-month window, there is a possibility that they may do better than liquid funds, but it may not be a linear move?
That's right,
it
absolutely.
could be wavering.
Absolutely,
okay.
absolutely.
Yeah, you want to add something, Suresh?
So, in view of the election, normally the arbitrage opportunities are there when there is going to be volatility. Probably in the next 1 month to maybe 3 months, there could be a lot of volatility, and maybe there is an opportunity for somebody who is investing in arbitrage funds. But I agree with both of them that you really cannot bet that there will be opportunities in arbitrage category. And we should really look at, say, something like 6% kind of returns or thereabouts. So that is the normal kind of returns you can expect from an arbitrage fund. So people who want to do something for the real short term, I mean, real short term means not 30 and 45 days, that probably again arbitrage funds will not sit in there. But below 1 year, so for them arbitrage and maybe ultra short liquid, those kind of things, along with that one can look at arbitrage funds, not because of the 8.5% which it is currently giving, which can vanish in a blip.
Okay, so don't look at the 8.5% return from arbitrage funds right now if you want to invest for the short term, because they anyways, I presume, gentlemen, all of you are saying, are not products designed for that time period. They are products designed for a different time period. So keep that at the back of your mind, and if you're still confused, please consult your financial advisor. I can't really do more on that, but I think we've given you enough clarity. I think the answer is a no when it comes to that. So a lot of conversations happening around that. It's important to have that discussion. The last piece and the last conversation that we want to have is the change in KYC norms. Again, somebody came up and said that the change in KYC norms are important. A lot of people are not aware of what needs to be done, how it can be done, etc., and what are the repercussions if nothing is done. Can we start off with you, Anant, on this?
The major change that has happened in KYC is now finally Aadhaar-based KYC is no longer valid. In short term, I think some of the distributors might say or might feel that it's an issue, but I feel in long term it's very good.
Sure.
Any which ways in Aadhaar-based KYC, we had upper limits, and we want to make our investors rich, to invest more money, to earn more money.
Sure.
So sooner or later, we were required to do physical KYCs. And if we are doing the same stuff on the very first day, I think there is no issue and it's absolutely fine. There is short-term pain for a long-term gain.
Okay. Vishal, does anybody have to do anything in order to comply with these new norms? Or if I have an existing mutual fund portfolio and my KYC was done back then, it stays true. Does anybody need to bother about these?
So this is not relevant so much for existing investors. It's more relevant for new investors who are going to come on board.
Okay.
Essentially, there was an eKYC model that existed. It got discontinued towards the latter part of 2018. It's come back, but from whatever we hear from the industry right now, there are a lot of challenges around the way it's working. Essentially, the mutual funds were all supposed to do what is called centralized KYC, CKYC as it's popularly known. Unfortunately, the way this KYC system works now is that it actually goes back to the registrar. And therefore, what's happening is the mutual funds are actually saying, can we go back and make it CKYC compliant so that one KYC actually works for all instruments? And that's ultimately what I think most investors want. They're tired of going everywhere with their PAN cards and address proofs and photographs, signing documents. They don't even know what they're signing. And therefore, we think that ultimately, the more we can use technology for all of this, the better it is. It is an impediment, but like Anant said, it's probably not holding people back saying, I'm not going to invest because KYC is painful. I think it's more just making it easier, just like booking a cab is easier using Uber. But it's not like you don't travel by cab if Uber is not there.
But that's interesting you say that, because Suresh, when we were doing a story around the flows starting to trickle down since October, a couple of fund houses mentioned, or a couple of advisors mentioned, I'm forgetting who, that one of the issues could be that the authentication process has since then become a lot more different and difficult on a convenience basis than what used to be, and maybe that could also be one reason why there was some bit of dropping out. Now again, I guess it's only for new investors and not for existing investors. So existing investors don't have to worry. What does a new investor have to do in order to be compliant on the KYC front from, I believe, 1st of June is the date, if I'm not wrong?
Yeah.
So does he have to do anything dramatically different, or is it a smooth, linear process?
See, as far as the traditional KYC is concerned, 2-3 things are typically required. One is the PAN card, one is the Aadhaar card, one is the address proof. So those are the 2-3 things which we have been doing for a long time. So going back to what you mentioned, I don't think any investor who is really truly interested in investing in a mutual fund is going to be put off by this process, because as it is in a million other places, we are anyway giving all these things out. So this is the millionth one place where we are also giving this, and we are going to give it one time.
Okay.
So I don't think this is a challenge. I'm not really supporting this move towards a paper-driven system. But I'm saying that this is, we have to take the rough with the smooth. Yeah, I mean, this process is coming up. So, but I don't think this is a deal breaker.
Okay, not a deal breaker at all.
Yeah.
Cool. Jaiman, thank you so much. Varied topics, not all of them linked to each other, but important because they are in the conversation table. We're getting a lot of queries around them, and therefore important to address these to all you gentlemen. Thank you so much for taking the time out and being with us on the Mutual Fund Show. And viewers, I hope we were able to answer some of the queries. I know we can't answer all, but we tried to take the 3 or 4 which were top of the list based on the feedback that we're getting from all of you, and try and answer them with our experts. Thanks so much for watching this leg of the Mutual Fund Show.